Good morning and welcome to this special edition or special global edition of our Investments Insight series, where we try to help you navigate through these turbulent waters and sail off into the future with a solid long-term investment portfolio. My name's Robin Johnson and I'll be hosting this discussion with a cracking set of global fund managers from around the world. Now, I don't know about you, but it seems like this year's flying by. And it seems such a long time ago where we were worrying about sustainably high inflation and the direction that central banks will be taking in 2022. Things have obviously moved on since then, and whilst I have a usually reliable WhatsApp group, a message came through indicating that police are joining the hunt for COVID-19 as it seems to have dropped off all media coverage whatsoever. Now, joking aside, the news coverage has obviously been usurped by what's been going on in the Ukraine and the global reaction to Vladimir Putin's claims that his strategic defensive maneuvers. Now, on the back of this and the ensuing sanctions, we've seen the ruble push out to 130. The Moscow Stock Exchange closed on February the 25th and hasn't reopened since. The constituents and their ADR equivalents have been marked down to zero or near zero in most investment portfolios. The Russian central bank raised interest rates to 20%, and in the last, when the Russian 10-year last priced on March the 4th, the yield was up at about 19.9% as well. Now, around the world, this has had a massive impact on already jittery equity markets, with the US down about 12.3% and Europe down between 16 and 19%. Before yesterday, that was when we saw a 7% gain on the DAX and the CAC. Developed market government bond yields have retraced the steps from early January, and the 10-year Treasury fell from its peak just over 2% back down to 175. That has pushed back up again since. But EM bond yields have also somewhat followed the Russian 10-year, and the South African 10-year now sitting at hovering around the 10% mark. Commodities have gone wild, gone on a bit of a tear. Everybody's headline news is about the oil price, pushed up to its peak at just over 130, now back down to around the 110 mark. But it's obviously creating worries and concerns about inflationary pressures and energy consumption around the world. And also, the bad boy of natural resources, coal, has seen a jump from 155 at the beginning of Jan to its peak of around 422. I think overnight it was at around 420. So to help us gain a bit more insight into the driving forces behind a lot of these moves, we've pulled together, as I said, a cracking set of our portfolio managers from our partners on our best of breed range. We have Tony Cousins, from Chief Investment Officer of Perfect International and portfolio managers of our Nedgroup Investments Global Cautious Fund. We have Andrew Headley from Veritas Asset Management, Head of Global and Portfolio Manager of our Global Equity Fund. And we have Ian Beattie, from co-CIO from Menace Partners and Portfolio Manager on our Global Emerging Markets Fund. Now, together, I don't want to embarrass you here, gents, but together they have more than 90 years collective experience as analysts or portfolio managers. So no pressure, but we're expecting big things from this discussion today. So I'm going to kick off. Tony, I'm going to come to you first, and I'd like to ask you to give us a bit of an introduction on the current state of the global economic environment, and how has this shifted significantly since the war in Ukraine began?
Thanks, Rob. Good morning, everybody, and thanks for your time today. I mean, at this time, we really shouldn't forget the terrible things that are going on in Ukraine, but I guess our jobs are to look after our clients, so we need to take a good, hard, cold look at what's going on in the world economy. Before the war happened, what we were seeing is the recovery from COVID releasing a surge in demand on a supply-constrained economy. And this, as Rob mentioned, had led to a resurgence in inflation. Now, at the start of this, for several months, there was a big debate about whether this was transitory or whether it was sustained. Central banks, obviously hoping for the best, were firmly in the transitory camp. But every single print of inflation going higher made them feel more and more uncomfortable, and they gradually broke ranks and admitted that we have an inflation problem, and we do. This is most acute in the US, where the CPI has reached 7.5%. The labor market remains very tight. 7.5 million Americans have dropped out of the labor force during COVID. Rents are 30% of the CPI calculation in the US. As sure as night follows day, they will follow capital prices in property, and those have risen sharply over the last year, so we can expect rents to keep going up. We see continued supply chain disruption. Asia's zero COVID policy is not helping here, and if you've tried to buy a new car or anything with semiconductors in, you will have been struggling, as chips have been one of the key victims of this. Now, the saving grace for the inflation dubs during this period was that commodities which had risen very sharply and are perhaps the most volatile element of inflation calculations, that they would fall back. But then Ukraine happened. We saw the invasion, and there's been an even greater surge in energy prices. This is particularly the case in Europe, where continental Europe depends on Russia for 30% of its oil and gas needs. It's a very complacent position to get themselves into, but it is what it is. And we've seen major increases in gas and oil prices, as Rob mentioned. Now, these start to have second line effects as well. If you look at something like the price of fertilizer, which is very energy intensive, this has risen 400 to 500% over the last year. And this is the sort of stuff that starts embedding inflation in economies and starts putting a few cents on the price of a loaf of bread and a pint of beer. Central banks are behind the curve here. Listen to Jerome Powell. Rates are going up, and quantitative liquidity conditions are going to be tightened. So I think we're going to be looking at a sea change in monetary policy going forward. Let's just take a look at money printing. Pre-global financial crisis, nobody did this. This is what Zimbabwe and Argentina did. The problems of the financial crisis led to this tool being legitimized, but in a fairly controlled fashion. The advent of COVID has led to an explosion in money printing. In the last 2 years, as much money has been printed by central banks as in the previous 12. So what we see here is a situation which led to a rapid rise in liquidity, zero interest rates, very loose monetary conditions, and this has fed through to booming equity markets until the beginning of this year. So that's sort of setting the scene for monetary conditions, which we do believe are about to change. Now, we'll obviously talk about that further during the webinar. I just do want to have make a quick mention about sanctions. I think the strength of the sanctions have surprised Putin. He saw what happened in 2014 when he annexed Crimea. Very little, frankly, but the reaction this time has been much more stringent and violent from the West. Nord Stream 2, the very important gas pipeline, has been at least temporarily postponed, may be cancelled. Banks have been taken off the SWIFT payment system, which is very important. Russia's central bank, which had built up massive foreign reserves, has been sanctioned, so it can't use those. And various commercial banks and oligarchs have had very severe sanctions put on them. What we've seen is a collapse in the ruble. We've seen queues outside Russian banks. Cash is essentially rationed, and a whole load of foreign companies are just shutting up shop in Russia. this is probably morally the right thing to do, but it is economically a very blunt instrument, and there is a danger of a financial accident here. Since 2014, claims on Russian banks have declined, but they still remain at $125 billion. These are mostly concentrated in Europe, where Italy, France, and Austria are most exposed. And if you want to see what the market is telling you here, just look at the prices of Unicredito, the largest Italian bank, which even after yesterday's bounce is down 38% in less than a month. SocGen, which is one of the big three French banks, is down 37%, even after yesterday's bounce. Now, all of this would be okay if markets were cheap. We are a value manager, and I'm afraid markets are not cheap. So I think what's important here is, remember, rule number one in investment: do not lose the money. Thanks, Rob.
Thanks, Tony. Very wise words to finish off there. Ian, I'd like to come to you now. And obviously a cornerstone of your investment process is that country selection matters. Quite a pertinent statement as we sit here looking at Russia. But with that in mind, do you have anything to add on to Tony's comments? And in particular, can I ask you to share with us as much insight as possible on Russia and how badly its economy and its businesses might be suffering right now and possibly into the future?
Yeah, well, first of all, even though I'm coming at it from a different perspective to Tony, I'd agree with what he's just said. You know, we had a huge period of excess liquidity. It was tightening already even before this, and now if you push up inflation with this shock on a scale that we haven't seen since the 1970s, really, and those oil price shocks, you know, you're going to have even less liquidity. It's just going to go into a massive deficit. The economy will crunch as a result. And so, yeah, and I suppose now the other big difference is inflation is now political. And we haven't seen that for a very, very long time in the West. So as before, you know, who got excited about inflation and money supply in the past? It was economists, central bankers, and people like us. And if I try to talk about it down the pub, nobody really would. Well, I would be very lonely very quickly, I think. And that has changed dramatically. And for good reason, right? So when that changed, I mean, think about all this excess money. It happens every time. Where does it go? Who does it enrich? It's the oil-producing countries or some other resource-rich country, usually on the periphery, and you end up enriching usually some dictator. And they've done it again. And so I think for geopolitical reasons and for the fact that domestic political reasons, they need to get inflation under control again, and that's never a particularly pleasant experience. And I suppose, you know, at the moment, because of what's happened here in the world, and it was going to be the case anyway, but now even more so, you do not want to be cold or poor, because fuel prices are going through the roof, food prices are going through the roof. As Tony said, even beer prices are going to be under a lot of pressure. So, you know, that's not great if you're a politician. You've got a lot of problems to sort out as well. So I suppose, you know, from the macro perspective, we're cycling through. We're going through a cycle at warp speed. This is actually all this stuff has happened in the past. We're just going through it incredibly quickly, and probably because of the size of the stimulus and the sort of shocks we had in the economy already, both monetary, fiscal, and COVID. You know, so we're just everything's happening bigger and faster. But for Russia specifically, getting onto your question, Rob, sorry. I suppose it's ironic that their invasion seems to be proceeding along sort of medieval lines of, you know, sort of bombardment of civilian populations with, you know, massive artillery pieces and rockets and bombs. So I suppose the technology is modern, but the tactics do appear to be straight out of the Middle Ages. And the sanctions and the economic response look to set the Russian economy back many decades, possibly even back even further. Absolutely devastating. Now, Putin's prepared for this, I think, as Tony hinted at as well. He's been preparing. He's been moving Russia to an autarky. to independence, to self-reliance. But it's very difficult to do that in a modern economy, especially for someone like Russia. You need the technology, you need the higher end stuff from the West, and you need to be able to export, although not as much as most countries, because it is not a very large population. So they do have food and they do have fuel, but they just don't have many people to trade with anymore. So it's devastating. You're obviously seeing early signs of hyperinflation. You saw some bank runs. Narrow money is going, I'm sure, is going hyperbolic. They can meet that because they can print their own currency, but it's going to be pretty horrible. And you see various estimates of how much this war cost. War is obviously always very costly in financial terms as well as in human suffering. And I've seen estimates of between $2 and $20 billion a day. Now, I think the upper end of that estimate comes from the US analysts. I suspect a Russian army is cheaper than a US military expedition. But you only have to look through history and see when deficits surge for Western countries. It's when they're involved in a war. These things are incredibly costly, and it is taking much longer than probably it appears that they expected. They've changed their strategy as a result, which doesn't probably get a lot of coverage in the press. But despite their preparations for sanctions, I think the Western response was bigger than expected. I don't think people probably modelled the freezing of central bank assets effectively. So Russia has huge foreign exchange reserves, but if you've lost up to half of them, we've lost access to them, and that obviously crimps their strategy a lot. And I think the other thing that caught everybody by surprise was the unified response of the Western powers in particular. So it wasn't just the US and her normal allies. Europe changed dramatically. I mean, to have seen Sweden abandon neutrality, and Finland and Switzerland for the first time in I don't know how many 100 years, all in a week, is quite an impressive achievement by Mr. Putin. To have just solidified the West and unified them quite so dramatically. So again, I don't think leaders of other countries probably modelled that sort of rapid response. There's obviously had stepped over the line here.
Thank you very much, Ian. Just before we move on to you, Andy, I'd just like to point out to everybody joining that you do have the option to ask questions to our panelists, top left of your screen there. So please send them through. I'll pick them up on the iPad here. Apologies for not mentioning that earlier. It wasn't on my notes, and I always miss things like that. So anyway, back to the conversation. So Andy, can you give us an indication of how this the impact that this might have on global developed markets, and maybe more particularly as a stock selector or a company selector on the constituent companies around the world, and maybe their exposure, and was there any direct or indirect exposure in your portfolio that you need to be concerned about?
Thanks, Rob. Morning, everybody. And for everybody listening, it's interesting because Tony, Ian, and I clearly all agree on the situation as we stand, but we haven't. This is not pre-prepared or discussed in advance. So in terms of the macro impact, I think we all agree. So there's realistically three things that we need to consider from an equity standpoint. I think one is obviously direct revenue exposure. So do we have any companies quoted in Russia or Russian revenue? And if we do, are they on the sanctions? Are they not on the sanction list? Secondly, is the kind of wider increase in the equity risk premium. So that's what we've seen across global markets. And then thirdly is FX. So I will just briefly touch on all of those. Starting with the equity risk premium, obviously, geopolitical risk has risen, minor chance of sort of nuclear. So because of these things, we've seen equity markets decline. It's no surprise as this has come about just with an increased equity risk premium. And I think in some ways it might provide some opportunity, but again, I agree with Tony and Ian that markets started quite expensive. In terms of direct revenue exposure, we have very little. We have no companies quoted within Russia or Eastern Europe in our portfolio. We've been through every company. Obviously, not every company discloses Russian revenue specifically. So something like Alphabet doesn't disclose Russian revenue, but we've had a reasonable guess. We've contacted a lot of companies. The company we have with the largest revenue exposure is MasterCard. They've disclosed it's around 4% of revenue, and some of that will be cross-border. So cross-border tends to be a bit more profitable for the card companies, card networks. So there is an impact on something like MasterCard. Equally, we were talking to one of our holdings, Cooper companies. They make, well, they have two sets of products. They make contact lenses and fertility products. And we were talking to them yesterday, and they have around 1.5% revenue exposure to Russia, but both of those products are not on the sanction list, so they are still selling in Russia. They still have 4 months inventory, they think. So they haven't got a problem supplying into Russia. They can also supply in. They haven't got a problem supplying into Russia through Poland. So the impact is mixed. If we go across our whole portfolio, we have a 0.7% revenue exposure to Russia. And obviously some of that will be mitigated because we have quite a lot of that is healthcare. So Thermo Fisher, Cooper, which are those products are not on the sanction list. So we're probably at around 0.5% of the portfolio, something like that, in terms of absolute revenue exposure. So for us, it's minimal in terms of direct exposure. So then just turning to the last thing, and I know we're going to discuss this more widely, is just the FX. So obviously we've seen the ruble collapse, but also, you know, the Hungarian forint, anything that's like Eastern European. In fact, the general rule of war, which I didn't know before, so I'm not professing to be an expert on this, but the general rule of war and currencies is the closer you are physically to the action, the more your currency gets affected. So and I think if you look at what we've got in terms of the starting point, it seems likely that inflation is going to run higher in Europe than in the US over time, because as a consequence of war, because we've obviously got the agricultural point that both Tony and Ian have made, the energy point. Europe is far more reliant on Russian energy than the US is. Interestingly, Korea and Japan are very reliant on imported energy, so they're going to have an impact. So in terms of FX, we'd expect really the euro probably to be most affected, followed by sterling, followed by the yen, and then the dollar to be strongest. Obviously, currencies being a relative game. So we have to take that into account. Obviously, the Swiss franc are probably okay as well. So when we're looking at our holdings, we have to take account of the currency, because I think over the long term, currency can really make a big difference to your overall returns. And so it's something that we're constantly assessing within the portfolio, and we will make changes if necessary, you know, to try and either increase dollar exposure or take some hedging.
Thanks, Andy. Some very interesting comments there, and it actually illustrates how much more of a knock-on impact this will have into areas that you don't necessarily think about immediately, such as the healthcare stocks that you mentioned. Now, it sounds like from all of you, it sounds like there's many reasons to be cautious at the moment with your investment portfolio. But, you know, Andy, what are some of the other factors that it's really important not to take your eye off at the moment? Because obviously we're all drawn to what's going on in Europe. But what about the rest of the world? Things that we might have kind of put to the side or not been, well, from the media coverage, we're not getting as much attention on. Where else do we need to be worried?
Yeah, so it is, we were already at an interesting stage in markets before the Russian invasion of Ukraine. So we were clearly seeing some of the air come out of the very highly valued, largely loss-making tech companies that had done extremely well during COVID. And I think Ian touched on the massive amount of liquidity that's been pumped into markets. And really these companies have ridden that liquidity up. And so as we saw QE moving towards the idea of quantitative tightening and this liquidity coming out, we'd already started to see some of these these companies, excuse me, decline. I mean, things like Robinhood off 90%, Peloton off 80+%, Pinterest off 75%, PayPal off 70%. I mean, these are big falls for these companies that had started well before Russia started invading Ukraine. And so we were starting to see, in terms of the risks, and certainly before the Russian invasion, we saw a huge amount of asymmetric risk to the downside. So you could start with obviously the inflation risk. Inflation was not transitory, is not transitory. It will fall from the very high level it is, but it's going to remain persistently high for some time. And obviously Russia, Ukraine won't help that. So we then have an interest rate risk. And a lot of these asset valuations around the world are resting on the pinhead of tiny interest rates. Okay, so if interest rates start to rise, then that affects all asset valuations. You know, interest rates act as gravity on asset valuation. So as we see interest rates start to rise to temper inflation, then we will see asset values start to decline. We've got the liquidity risk, quantitative easing moving to quantitative tightening, we've already discussed. We've got a valuation risk. You know, valuations of assets are very high. They have come down a bit, so that is alleviated a little bit in the last month or two, but they're still very high compared to history. We think we've probably got a growth risk around the world. There's definitely a margin risk. Margins are at all-time highs. It seems to us that inflation is going to erode some of that margin. We're going to see increasing demands for labour, so wage pressure. I think, interestingly, for the last 20 odd years or 30 years, with inflation having been so low, as a worker, you can kind of ignore 1 to 2% inflation, and you don't go to your boss and demand a pay rise, because the cost of living is rising, but very slowly, and so you don't really notice it. But when you see inflation, and realistically for the consumer, it's probably running around 8, 9, 10%. You have to go to your boss and ask for a pay rise, and so we're going to see more pay rises requested. So wage inflation is going to come through. And then we've obviously got geopolitical risk still. So we've got Ukraine and Russia, which we knew about, but we still have issues in China. So I guess I think that China potentially is a bigger issue. Obviously, that, I mean, when I say that, I'm not trying to downplay certainly the humanitarian crisis that's going on in Ukraine is obviously devastating. But from an economic standpoint, I think China could be a bigger risk than Russia, Ukraine. And so I'd be interested in Ian and Tony's perspective on what they might think is going on in China, and growth slowdown, any prospect of, I guess, you know, has this put the Chinese off invading Taiwan in the near future?
Yeah, thanks very much, Andy. Just before Ian, I will come to you on that question on China. A couple of questions that have come through to me here. Yes, the Russian stock exchange is closed still, and you cannot trade any securities listed in Russia. Ian, you can let us know about the ADRs, how they're trading that aren't listed there. And then I think, Andy, you mentioned about importers of energy. I mean, think China imports 70% of their oil and 40% of their natural gas. So they're, again, heavily reliant, and it's having a big impact on their cost of energy production or energy usage. So Ian, over to you on China. What implications? And there was a big article in the FT this morning about how maybe they're moving away from their recently announced strategic or tighter alliance with Putin.
Yeah, so I'm going to try and keep this tight, because obviously you can imagine we've been debating this and talking about this for hours, and we could go on for days. But I think Mr. Xi is in a tricky position. I suspect, and obviously nobody really knows, but I suspect he was given some kind of heads up, but was also given wrong information about exactly what Putin was up to, and I'm sure did not expect that we'd still be here watching an artillery barrage of civilian population and hospitals and children on day 15 of the invasion. So whether he was said, oh, there'll be a police action and we'll try and the Russian-speaking people in Ukraine will be welcoming us with open arms, or whatever the misinformation that Putin was probably receiving. Because we know that these sort of regimes are very bad at information. That's why they struggle with getting into the higher levels of technology and the higher service economies. A market economy transmits information. That's what prices do. So Putin, with his command and control structure, is, nobody wants to tell him the bad news, right? So I think they've made this blunder, and Xi has probably got too close, and now he's in a tricky spot. Now, normally China is very independent from Russia, and there is often no natural alignment of interests, and they will ally when they need to ally, and they'll be opposed to one another when they need to be opposed. That has always been the case. But there is a personal, there seems to be some personal link between Putin and Xi, and this is probably testing that. So China's in a very tricky spot. Yes, of course, it could act purely opportunistically, and could almost turn Russia into a client state, a vassal state. They would be the dominant partner by far and the buyer of their commodities and bankrolling the whole economy. But there's obviously huge risks with that. Firstly, do they trust them? Would they trust a post-Putin Russia? Would they even trust a Putin-led Russia? So I'm not sure that would be the case. But secondly, and probably more important in the short term, is what would be the response of the West? Because the other thing that I'm sure has taken them all by surprise is the fact that the West was far more unified than they probably modelled. And that's probably a corollary of this invasion being a full-on invasion of the country and not trying to take another piece of it like they did last time. So that's why I think the response has been so dramatic and unified. And I suspect China wasn't expecting that either, which does two things. One, it makes their next move, makes them probably a bit more cautious, probably, I say, even though there are huge opportunities for them financially to, I don't know, go and buy Gazprom or something, or a big stake in Gazprom at almost zip, which I'm sure they would love to do, given their resource demands. But also, I think it has shown that they are not an autarky by any means. They cannot be removed from the global financial system or economic system so easily without, catastrophic impact on their economy. I mean, Russia is a tiny economy, but it makes things that people need. It produces oil and gas and, steel and, stuff that people, need. And food, probably most importantly of all, as we've said, both Ukraine and Russia generate huge amounts of grain. But China produces what you want. It takes raw materials, imports them, and turns them into goods that you want, not that you need. So, yeah, if there were sanctions on China, it would be horrendous for the Chinese economy. Also, their foreign exchange reserves are sitting at the Fed and other central banks. They're not as they haven't hidden them, squirreled them away in other places for this kind of thing. So it would be very. It's a bit of a warning shot to China, probably, that it's more exposed than it thinks. Now, we can all speculate on what the future game plan for China wants. It talks about reunification and so on with its rogue province. But although that, for me, that was a relatively low risk, but that was increasing in probability, I personally think it has now been pushed further away. It's lowered in probability, because this is a European theatre. This is the EU's responsibility. As Tony said, they are the ones that got themselves addicted to Russian oil. The US is probably fuming. It's another foreign policy disaster. They just get bigger and bigger. And the US has got to realise that it can't leave the Europeans to handle these matters. But it's not actually on the Americans' front door, whereas they probably see the Pacific theatre as their responsibility. So, and the other thing I think that might have seen risk actually lower once things have calmed down is that we'll keep everybody probably a bit more cautious. So the Americans like to keep a lid on Taiwan expectations as well. They don't want a declaration of independence from Taiwan, which will raise the temperature and mean that you might lose control of events. You might lose, there might become a momentum in these things that then everybody takes entrenched views and so on. What I think maybe China and certainly Putin underestimated here is how democracies work. Because they probably analyze this and say, oh, look, why would the Europeans make such a fuss? It's not in their interests. They need Russian gas. Well, that democracy doesn't work like that. The pictures on our TV screens of the horrendous bombardment and the women and children being killed hardens public opinion, which then puts pressure on politicians to do something about it. Which, of course, maybe that's a reflex that a Western politician understands a bit better. And that's the situation we're in. So the more, as this worsens, you see the pressure on Western democracies, politicians to do something increase.
Thanks very much, Ian. You touched on the reserves of the Chinese central bank being held by the Fed. Tony, I'm going to come to you. We had a question come in. How can foreign countries freeze central bank assets like in Russia and as Ian mentioned? But do you have any additional comments to what Ian has said? But also, are there these developments around the world, how does that, looking forward, how does that affect inflation and currencies, or are there impact on inflation rates and currencies around the world? Andy touched on it a bit earlier.
Sure, yeah. I mean, well, first let me say I agree with everything that Ian and Andy said. It's a shame these things often work better when you're arguing, but we don't argue, and we're not arguing here, and the facts are very, very stark. I think U.S. sanctions are very, very powerful. People do not disobey sanctions because if you do, you're in a lot of trouble. So these will work, and they can freeze Russian central bank assets if they're out of the country. This is a titanic miscalculation by Putin. He looked at 2014 when he took Crimea, and the Crimeans generally welcomed him in, and he thought this will be the same again. And it isn't. It isn't at all. And he's turning himself into an international pariah, probably already there, by the, as Ian said, the medieval actions that he's having to take to try and make progress, which simply isn't happening. So, coming back to, I guess, how we started, we were already in a supply-constrained world. This is going to be restricting the supplies of and also willingness to buy Russian hydrocarbons, and that's going to make the inflation problem worse, and that makes Jerome Powell's job terribly difficult. Central bankers since Greenspan, Bernanke, Yellen said it's not our job to control bubbles. Well, frankly, if it isn't their job, I'm not quite sure whose it is. Again, ultra lax monetary policy has led us into a bubble, and that is now changing. And this situation just exacerbates it. As Andrew said, these valuations rest on the pinhead of exceptionally low interest rates, and those are going to change. So that is, I think, the key concern here. I saw Ian raising his hand, so perhaps he wants to pick up on something I said there.
Yeah, thanks, Tony. Ian?
Yeah, I'm picking up the challenge of trying to find something to disagree on, so I will come on to that in a moment. It's always a bit worrying when we all agree on these things, isn't it? Because I just think, where are we going to be wrong then? Just a quick one on sanctions, though, just to give you a sort of little anecdote of how hard it would be, even if you were a bad actor. Because as Tony says, financial sanctions and restricting the central bank assets, which I had never seen, they do it for Venezuela and places, but not for, one of the bigger central banks. So, but these sanctions are very difficult. So obviously a smuggler can, sneak a little ship full of metals in somewhere, and that's going to get through. But these important, these really big commodities, they're really bulky, and although they've soared in value, that to actually make any decent money out of it, you need not just a tanker, you need 30 tankers of grain or something to make a difference. And you can't get it out of the Black Sea because you can't get insurance. And there's a war zone anyway. So, what are you going to do? Stick it on a train to go 2,000 miles to the east? Or are you going to get it to the Baltics? If you get it to the Baltics, even if you're, I don't know, I'm not going to name anybody. Let's say it's a bad actor somewhere else, right? You're going to send all these ships around. You're going to pick them up in the Baltics if you do, and then they can't be Russian flagged. Otherwise, you've got to bring them all the way back. You've got to get past the Scandinavians, who suddenly are no longer neutral. You've got to get past Germany. You've got to go past, the UK and France through that little tiny gap there those are quite successful navies who could easily pick you off and impose the sanctions. Then they're going to get past Gibraltar again, and then, through the Med, and they're going to get past Egypt, which is the biggest buyer of grain from Ukraine. So they're going to be going very hungry. And that's before you get to, so it's just not happening for the bulky, important commodities. But I will pick on somewhere. So we're all sounding very gloomy. So we'll find somewhere to disagree slightly. We are cycling through this incredibly quickly. So we're going through, warp speed, if you're of that generation. And I think that does change things slightly, because I think central banks are now, for all sorts of reasons, A, because it's now domestically politically important, and B, geopolitically important. Surely they can see in the US that they are financing these bad actors all over the world every time, and so they are gonna kill it. The economy as well, because of the price shock, will contract, and so all the central banks have to do is not cave in as much as they normally would, and this will start to come back in line, I think. So I think there's a chance that we will cycle through incredibly quickly. The economy will get crunched as a result. Like I said, you really don't want to be poor and cold. And your fuel bills, for many people even in developed countries like France or the UK, if they were passed on, which is a big if, I suspect governments will step in. If they're passed on, will be bigger than most people's mortgages or their rents. So there's going to be huge disruption. But I think you see there that if you can find some, and this is where I might be disagreeing slightly, there are then going to be some opportunities. Now, I'm not saying this week, but as you move through perhaps the summer, we need to start thinking about the really good quality growth stocks. I'm not talking about ones that don't make money. I'm talking about ones that, are positioned that will be eking out some stable returns on capital here, and maybe doing finding the new technologies. And we could talk about renewables that I think people are going to be spending more. Maybe electric vehicles, maybe they need to be a bit cheaper than they are at the moment. But, there are areas here that you think this is going to be the next bull market, that we're going to end up with a crunched economy, and we're going to end up with some bargains. And they might be in some very exciting areas that could lead the next bull market. So we've probably got a couple of quarters to maybe find these and get involved. And it will be, you're going to be participating in the next bull market. But what I will say is, because we're cycling through so quickly, we might not have as much time as normal. I mean, it's obvious why we're going through, and the other thing is there's going to be more volatility. So this period of very, very low volatility is over, I think, for even longer than this disruption. And that's just a result of the massive dislocations we've had, because, we had the huge liquidity, we had the pandemic, we then had more liquidity and huge fiscal responses that we might have to see more of, because I just said, I don't think the consumer can handle these fuel bills that are going to come through. And then we've got a war on top. So when you do that to an economy and a financial system, you can't just suddenly stop that. The reverberations will continue, and there'll be secondary and even third order impacts and volatility in, I think, in both directions as the flows ebb. I think within this, I don't want to be sort of ultra optimistic here. We're still very, we still want to be defensive at the moment, but I think we're rapidly approaching a point where we need to start getting on the front foot and looking for opportunities in what's going to lead the next bull market, because of the impact of this. Actually, is just meaning we're going through this cycle even quicker than normal.
Ian, thanks very much. Andy, I'm going to come to you, but just before we do that, I'm conscious we've gone well over time. I'd like to keep you gentlemen continue the discussion if you don't mind. But if anybody joining needs to drop off, then please do so. We'll put the recording of the conversation out after this. Tony, are you still okay to stay? I know you have a meeting after.
Yeah, I've got a few more minutes,
Okay.
but then I'll have to go.
Okay, thank you very much. So I'll kick on for a few more minutes. So thanks for everybody who does have to drop off. But Andy, I'll come to you now. I saw you raising your hand there, and this obviously does potentially increase some opportunities. And so where might those be, or what was your comment that you were looking to make?
Yeah, so actually Ian largely preempted what I was going to say, but actually, so we've got quite a bit of cash in the portfolio, which we had coming into 2022, back on those risks I was talking about, the asymmetric risk to the downside. And I have to say, we're starting to get quite excited about a few things. I mean, we're long-term investors. Our average holding period for a company when we bought it is somewhere between 6 and 7 years. So we're looking out for a long period of time when we're buying these things. And we're seeing companies that have fallen, 30, 40, 50% in some cases, and they're high quality companies. So they're often their free cash flow yield has gone from maybe 3% or 2.5% to 5 or 6%. And so we are actually starting to get excited already. We do realize, and I agree with Ian, that we may see, probably will see another quarter or two of high volatility. So we are not going to be picking the bottom of these stocks here. But there's a number of names that we're looking at that we are beginning to get excited by. So I guess I just didn't want to leave everybody with this idea that, oh my God, everything's going terribly. We think there'll be some opportunity. We own companies that, we own plenty of companies that are growing at low double digit, that are on maybe 10 to 12 times earnings. They're demonstrably not expensive. And so we think there will be some opportunity coming up. So I don't want to leave everybody thinking, oh, this is terrible. I think that actually over the next quarter or two is an opportune time to invest if you have a 5-year plus horizon. The valuations remain high, but I think if you're with somebody that can pick out quality companies at good valuations, and I know it's also what the other guys do in terms of looking for good value. I think there are going to be some great opportunities coming up. So I just wanted to leave that thought, really, Rob.
Thanks, Andy. I mean, so I love the focus on the long-term perspective. I just wanted to ask a quick question to all of you, really. If you look forward from a long-term perspective, has anything structurally changed on the back of this conflict? I mean, we see BP dump its investment in Rosneft and give up that revenue. So there are things, and with the whole, the recent focus on sustainability, there's been a much keener interest on just dumping things that have bad governance and bad implications or humanitarian implications. Ian, I see you've raised your hands.
Yeah, so I'm going to talk my own book, so apologies in advance for the plug. I don't mean literally the book, I mean our process. We've always said, because we're emerging market specialists, you have to do macro, you have to do country. And I would also say, everybody talks about ESG at the stock level, but you have to do ESG at the country level, and we always have done. And the emphasis has got to be on the G. It's got to be on the governance, on the institutional quality, because without that, you can forget about your E and your S and probably everything else that's reliable. And so this is just yet another example, unfortunately, one that's affected the rest of the world. But you see it in emerging markets all the time. There's no way, without good governance and without good institutional quality, a country will ever escape the middle income trap or get promoted up to the next level of development. I mean, there's a reason why Singapore went from one of the poorest countries in Asia to one of the richest countries in the world. They couldn't have done that without high institutional quality. And that's the same for, you know, all these emerging markets. And there's the reason why Russia's still poor. It's always been stuck here. You know, since the 20th century, it was still stuck here. It's still stuck here today. And, you know, Argentina's stuck there, you know, so it's really important to look at these factors and take them into account. And it doesn't matter whether you do it from a moral perspective or whether you do it out of your own self-interests. It's important that you look at these factors.
Thank you. And Tony, so at the moment, are we in a risk off, risk on scenario looking forward?
I think we are, despite yesterday's bounce. You know, these things we've talked about will play out over coming months. Valuations just do need to correct more. I'm probably a bit more cautious. I guess, you know, we run the cautious fund. I would say that, wouldn't I? You know, what you have to do is remember cycles of fear and greed, and some assets will get very cheap in the next few months. And Andy and Ian are right. There will be opportunities, and you need to have the discipline of process to go in and buy them. In terms of structural changes, I mean, Ian is absolutely right here. You know, this is a gargantuan blunder by Russia that's going to set it back decades. And, you know, when we've seen other countries do this, seen Venezuela do this as well. And it's you're just becoming international pariah, and you don't recover from that quickly. You know, we've seen so many companies just decide, well, I made some money in Russia, I continue to make money in Russia, but it's just not worth the bad reputation within my main markets to continue that. So we're dumping it. This is a huge disservice to the Russian people.
Thanks, Tony. And Andy, how's the portfolio? I mean, you touched on it just now, but how's the portfolio positioned for the near and longer term?
Yeah, I mean, I feel the portfolio's positioned fine. I mean, I agree. Disappointingly, again, I agree with Ian and Tony. It's plus ça change, plus c'est la même chose. But I guess the one other structural factor, apart from Russia kind of pushing itself back 50 years, is I worry that maybe the climate change gets pushed back further in the agenda. You know, that just the requirement for people to get heating and stuff, that we're going to go back and use more coal and use more oil for a longer period of time, that it's going to take longer perhaps to get to a cleaner energy situation than it would have done prior to this, maybe one of the implications. But other than that, I think, you know, 3-4 years down the road, it'll be obviously solely from a economic point of view, it'll be a blip in the movement of global markets, developed markets, let's say. From a humanitarian point of view, and for the poor people in Ukraine, obviously it's I mean, it's obviously devastating. So I know we're talking here about the economic and market implication, but we mustn't forget that there is obviously a much more serious and real implication for the people on the ground in the Ukraine and those refugees.
Okay, thank you very much, gentlemen. I'm probably going to wind it up there, given we've gone a long way over time. I'll say thank you to all three of you for getting up bright and early in the UK this morning. I really appreciate it and joining us. A bit disappointed there was not more infighting, but as you all said, look, you know, great minds think alike. Collective experience says a lot, so hopefully you've given us some great direction for investment portfolios into the future. So to each one of you, Ian, Tony, Andy, thank you very much.
Yeah, thank you.
So quick summary, thanks to everybody who's joining us and still with us now. Interest rates potentially continue on their upward trajectory for the rest of the year as inflation stays sustainably higher. What that means for global equity markets, not too sure. There could be some potential opportunity, but volatility is definitely here to stay. Bond yields likely to trend higher around the world, even developed markets, and as we've seen in the emerging markets already. And commodity prices potentially staying higher for a bit longer than they may have, as the super cycle was potentially turning over. But there's still reasons to be cheerful, areas to invest, and very important point in time to make sure that you're with the right investment manager. So hopefully you've seen that our global investment experts from Veritas, Perford, and NS Partners have some incredibly skilled individuals to guide us through these turbulent times. Thanks very much for joining us. Please join us next week for our next Investments Insights, where my colleague Anil Jagmohan will be having another conversation with Dave Ford. Thanks very much for your time. Have a cracking day and look forward to seeing you again soon.